And we're certainly getting a lot to talk about today. Euro down to 103.
What happened
last night?
What happened here?
Eurozone PMIs came out and were weak. So remember the Purchasing Managers Index, or PMIs, they do them globally. We'll get ours in the U.S. a little later on today. But oversized reaction, absolutely. I mean, 130 pips downstroke on this, down to right above 103. But remember, we're also at a level where there's not a lot of footing underneath of recently traded ranges. So you get stops triggering some other stuff. You get a kind of that outsized move, reflexive move down.
Well, if we could pull up the chart here, you'll see that it's been a rough week here for the euro. They held in last week around the 106 to 107 range, which has been, we'll go through the data in just a second, has been a historical low for this market that we've bounced off a couple of times since the parity price point that we hit a couple of years ago. But yeah, Pete, maybe walk us through what happens, because you might be getting to your platform today and saying, oh, there must be like Russia must have sent off a bunch of missiles or something crazy must have happened. But this happened right at the same time as this PMI that comes out, and I'll show you the data. But I want you to walk us through, Pete. Where is it? Here it is. And I had to add the medium importance price economic calendar points.
This is, was it weak? Anything below 50 is considered contractionary territory. This is kind of fueling the loop. As this came out, there was a statement from one of the ECB governors that maybe it's 50 basis points they're going to be cutting towards the end of the year.
Gotcha.
So remember, that interest rate differential plays into FX, the relationship between two countries. Here we're talking about there's not 100% certainty the Fed's going to cut by 25 basis points. So we may get a cut in DC, we may not. Here they're talking about increasing the size of the cut.
It might have to be a big one.
In Europe. Yeah. And that will impact whether or not they do it is a different thing. But that sentiment, along with us plumbing levels we haven't seen in a very long time, creates...
Well, so not only is the euro area vulnerable from an actual macroeconomic standpoint, to your point.
The risk sentiment, again, Russia launching bigger missiles, the Ukrainians shooting missiles deeper into Russia. Does it help? Absolutely not. It adds, and today's Friday, and what's great about FX is you can get at product 24 hours a day, starting Sunday night at 3 through Friday at 4. But over the weekend, you've got event risk. So
100%.
You see that play into the equation. So, because you would say, tier 2 number, it's not a big number. Granted, it was weak, but why did we see such an outside move? We were at new lows. They're really testing anyone who wants to be long here, their resolve. We're going into a weekend. The liquidity will be a little bit thinner. Yeah. And we saw the downdraft and then a little bit of bounce back. But, we've seen this market progressively kind of trade lower. Its best it can do on the upside is kind of put together very small. When we say it's done better, when we look back a little bit of time, what we're seeing is, we've been able to put some lows in and rally 40, 50, 60 pips.
But not back to 108 or 109.
No, it doesn't challenge the shorts. It basically is some profit taking, a little bit of people probably dabbling, picking some bottoms, but it hasn't put anyone who's short this market to the test.
Well, and that's why I wanted you to add some more of that price action context, because this is one of those scenarios. It's not the same as, remember when Brexit was going on, and we knew that the vote might have already gone through, but there was like some number or something that happened during Asia, and they moved that pound market down through its lows, and it looked like this, where it was a massive gap lower.
But that was wasn't that 112 down to 105? I think
exactly. So not the same thing, but I do want to bring that up, and there are examples, every year of stuff like this, where the number that comes out doesn't necessarily correlate to the move that you're seeing, and this is a perfect storm scenario like that, where it's like you have a euro dollar market that's already weak.
Right.
I mean, yesterday we're staring at 105 all day, and it's not holding 105. And we'll show you the historical data in a second. 105 has been historically a level that they've bounced off of a lot of times. And so we're already down there, already in that vulnerable state. To your point, everybody's on edge with the Russian-Ukraine story once again escalating. You've got the Trump presidency and what that means for tariffs and how much the U.S. is going to help the Euro area amid geopolitical risk and everything else. And then you have this mid-tier number come out.
Right.
And it doesn't just miss, but to your point, they were expecting a 50 PMI, which is pretty much right in the middle, saying we're not growing, but we're not declining. They get a 48, which pretty clearly tells you we are declining. And you've got the interest rate story to boot, where the differential between how much they're going to cut versus the U.S. is going to cut is really moving this market, because in the same time that, they're now pricing in maybe a 50 bip cut, the U.S. is pricing in maybe a no cut.
Right.
And so you've got all these dynamics at play. But this is why you have to watch the market. This is why we show up. Because anybody that you see on Twitter or wherever, that everybody loves to come out with these clean matrices of like, this is, if non-farm does this, S&Ps will do this, and Eurodollar will do this. You have no clue.
Right.
Anytime you see stuff like that, and they're like, if this number does this, then this. This is the HCOB PMI composite flash that came out last night, and it's absolutely annihilating this euro down to lows that we have not seen in years. And same, we'll get to pound in a second, but same with pound, misses on this number that is a medium tier number that you and I have not looked at in over a year, or I don't know if we've ever talked about it. And now you have this Eurodollar market, Pete, that is, you can see here, I mean, this is a vicious move through the year lows, and now getting two lows that we haven't seen since the time that we hit parity.
Right. So it'll be an interesting day today. There'll be I think it'll be interesting to see if they can stage a little bit of bounce off of this. Sometimes it's a house cleaning. You know, they've squeezed the longs out now in that kind of price action. Or we end up towards the end of the day just kind of grinding a little bit lower. If we do, then chances are Sunday they'll put the markets to the test again, and we'll see. But absolutely play through in different ways. Aussie got hit on the Chinese stock markets, giving back some ground last night. We can take a look at cable to get a little bit of sense of where we are there. Lots of markets going on, moving by varying degrees. Dollar story, yes, but this is really, again, this sterling playing through on those numbers, not to the same degree. We're on a percentage basis. Are we off the 129, 130 highs? We are. But euro percentage-wise, and we can look at euro sterling. Euro is the weakest link here. So,
yeah, I think we're getting Beth and Bat and Tom through. Oh, there we go. They fixed it. Perfect. Thanks so much out there. Such a great team. But anyways, 125 here in the pound is not the equivalent of 104 for Eurodollar. But this is starting to gain steam as a move here.
Right, and let's back it out a little bit in terms of time-wise, too, and we'll see, are we getting to those levels where we start to, not quite there yet, but if we trade down towards the lower end of 124, we're going to really put, everybody who's been long in this run-up throughout the year is really going to kind of be put to the test a little bit. So we'll see. And
you could see euro maybe start to hold in a little bit better than we see this classic all the time.
And those are actually really interesting trades at points like this when we get to extremes. And you know, I think it really speaks to, okay, which way are you, a contrarian or a momentum? If you're a momentum guy and you're short, I mean, the world's working out for you really well
very
right
nice.
now. If you're a contrarian and you're disciplined, that this is incredibly cheap. But the markets are demonstrating a little bit more elasticity, so I'm going to define what's cheap, and I'm going to put some guide rails. I'm not going to say that if we had said this, 106 was cheap, 105 was cheap. 104 was cheap until it went to 103.
You love 103 half.
Well, and you don't want to get yourself in that box. So if you're going to be a contrarian, you know that momentum right now is leading to the downside. Is it overextended? At some point, it will be, and we'll see a more substantial correction. I don't know if that comes from par or that comes from here. We don't know. So setting your guide rails around, if I'm going to trade the extremes here, I'm going to be the contrarian, thinking about, okay, where, if you can't say in good conscience, okay, I'm going to nibble a little bit here, but if the market does roll over this afternoon, I'm going to get out. And it's you can't look at it like I'm getting out of a place that I think it's so cheap. It's what you're trying to get out of it. It's setting realistic expectations on both sides of the trade here. This is where contrarians sometimes get stuck, is they are not willing to accept that what was cheap is not cheap. The market's perfect, prices incredibly efficiently.
Yeah.
So what's cheap is an assumption by us, but put those guide rails around of managing, and don't feel that if I'm selling lows, if I'm going to take a little bit more heat here through 104 or 103 and a half, I'm going to stick to that, and I'm going to manage it. Maybe that is low or not. But if you play that game at 106 and 107, you actually are still able to sit in the game, and you're not stuck with really bad longs at this point. So think about, look and think a little bit about where you want to manage these expectations a little bit, and work from that. And that will let you continue to be a contrarian and not get so one way that you're, because I've seen this happen in my 40 years of trading. Guys get one way and they're like, I can't sell them. You get a 150 point rally in Euro. It's like, why don't you take some off? Oh, I can't. I'm long for this bad.
Yeah.
So you're basically saying all you're going to do is trade one side of the market, one side that isn't working, and you're not going to be able to manage your position.
Yeah.
You're not giving
you're
yourself
married to one price.
Right. And you're not giving yourself the flexibility you need to. What's great here is there's liquidity throughout the day. You can trade these all night long, all day long. You can use, if you're so inclined to, you can use stops to manage those levels. All those tools let you better engage with product and come back into, sure, we all have an assumption as to what's cheap and rich. The market will tell you that. And managing, maybe my idea of cheap isn't cheap. I think this is a really interesting, I mean, we have had, we had the big downdraft post-election, huge rally in Euro, huge rally in yen that was sold into, and we're continuing to see that selling.
Yeah.
Now, you've had, when you look at this chart, I'm glad you've had spots where you've gotten decent bounces. So what is your expectation?
Sure.
If you're long from 110 and you're waiting for 110, that's the problem.
Well, and
keep the expectations realistic as to what the market's giving you.
Well, and I can very honestly say, using Pete as an example, I have seen you in whatever market, and I don't want to give specific examples, but whatever market, get short at the extreme or long at the extreme with looking for a contrarian play, and bail out of that market at a further extreme, which feels awful, right? Like, as an example, let's say, you're looking at the gold market a couple of months ago, and you sell 2750s, but you tell yourself with good mechanics, I'm only taking this market for $20 on either side of 2750, and you feel awful buying 2770s. It feels awful. But then if it gets to 2800 or 2850, you're in the game that you can trade again, and you're not married to that 2750 to 2800 to 2850 and so on. And so it might feel awful, but again, I have seen you do exactly that thing, which feels bad in the moment, but it frees up the rest of your day, the rest of your week, your whole portfolio, even though it's like, oh man, I bought 104s and I have to sell the 103.75s, and it's like, it feels bad. It's like, I can't believe I'm selling 103.75s to get out of this position, especially when you look at this chart. But look at, man, we traded below parity for weeks. Now, it wasn't years, but it was weeks.
Right, but it's keeping yourself balanced as to being able to trade both sides of the market. That doesn't mean like I've got to always be long and short. It's the flexibility that you're not married to one position in one direction. That will keep you engaged in the game. So,
and here I present you one more thing before we get out of here. We only have a couple minutes. Is okay, maybe you're long euros from a bad price or whatever, or maybe you've just got so much, short U.S. dollar exposure that's accumulating because U.S. dollar is beating the heck out of so many different currencies. I present to you this euro sterling market, because another point here that you could make is if I'm looking at my portfolio, Pete, and I'm long Aussie and I'm long euros and I'm long maybe even sterling as well. I'm long Kiwi, all these different things.
Short a lot of dollars.
Short a lot of dollar. I'm long CAD, which CAD has actually come back a little. But anyways, you look at a currency cross like this, and you might say to yourself, well, if I'm essentially long $10,000 worth of all these different markets and short $10,000 worth of USD, what if I peeled off long $1,000 or $2,000 of my euro dollar exposure and transferred that into long euro sterling exposure? Because this is actually a pretty crazy extreme. And now you technically maybe missed the low. Maybe it gets back down here at some point today, but I mean,
was put in a very interesting at a different time.
And this is a crazy one as well. This takes your U.S. dollar exposure out of it, Pete, but it still keeps you in that long euro exposure, and it just diversifies you a little bit differently, because I mean, this is just as historic and extreme as that euro dollar, and you get the U.S. dollar is just really. It's hurting a lot of people right now who are stuck on the short side of it, because it is unrelenting across all these different pairs. You could take a look at a cross like this.
One of the great things with SpotFX, building this, impossible to do with ETFs, difficult to do with futures. Here you could trade it as a single contract, which is great, a single trade. Euro sterling, pulling out that dollar component, next level diversification. It is something worth looking at as you go down your FX journey. You're going to see, and again, 80 FX pairs doesn't mean you become a master of all of them. Turkish lira, no. There's some people who love that for carry play. That's not where we're going to start the discussion. But next level diversification, diversifying out of some of your dollar exposure and looking at non-dollar pairs, it's a simple step to make. And it's really just looking at a different set of extremes. So if we're indifferent traders, and as tasty traders we are, we're indifferent to product, it's liquid, it's available to me, I can trade it, it's got capital efficiency. This is a great product to start to get involved in and look at that next level of diversity. And you're right, when we start talking about how do we peel away just being short or long dollars. Being short or long dollars is one way to find occurrences outside of our core equities portfolio.
Sure.
This is the next step to it. And something we'll continue to simplify for everyone in the process. So if you do want to learn more, tastyfx.com. There is stuff for if you're new to FX or you're an experienced trader, lots of resources there. It's easy to open an account or fund, and we have a demo environment. You can actually kick around a little bit. So very straightforward process, and we're here to help you along on that journey.
Yeah, that's right.
This is exciting. Good way to wrap up the week. Interesting tape action. We're getting some ranges, which is great to see. And if you want stuff cheap, you've got it cheap. So we'll see what that turns out to be next week.
Yeah.
But we've got extremes, we've got movement, all good things for FX.
Cool, man.
We'll see you back here on Monday, guys. Have a great day.